confidence, control, knowledge, safety, success, investing, making money, money school. What are stocks and bonds? That's where you'll start and move rapidly into the how-tos of working with a broker, buying stocks and bonds, reading the financial pages, and so much more. Craig Lewis, certified financial planner and longtime money manager, will be your guide through the financial jungle. The goal is for you to gain the knowledge you need to make informed decisions and succeed. And now your guide, Craig Lewis.
What was the risk of putting $1,000 into a bond in 1980 that is going to mature for $1,000 in the year 2000, AAA rated? If you're going to hold it until 2000, there's probably not any risk. But if you wanted to get out before maturity, there's a risk of market fluctuation. When interest rates in general go up, bond prices go down. When interest rates go down, bond prices go up. If I bought a bond in 1980 that pays a 10% rate of interest, 10% is the coupon rate. ABC gives me an IOU for 10%, and I'll get back $1,000 January 1st in the year 2000. Now I want to take that IOU and sell it in the open market. At that time, interest rates have gone up. Now someone could buy a brand new IOU that would mature in 2000 and can get 12%. Why would they pay me $1,000 when they could lend $1,000 to someone else and get 12%? Mine is going to give a 10% income stream. Therefore, they're not going to pay me the full $1,000. They might pay $990 or $980, whatever equals out to about the same return. So therefore, if interest rates go up, my bond value goes down. Now, $1,000 is called par. If the bond price is under $1,000, we call that a discount. Think of it as a discount store at below average prices. If instead interest rates have gone down, now the average bond of that coupon rate of that maturity is trading at 8%. And I have a 10% bond that I want to sell in the open market. I'll be able to get more than $1,000 for it because my income stream is greater. They might pay me $1,100 for it. If I get $1,100 for the bond, that is called a premium. Take a look at this bond. An IOU 10% from ABC cost $1,000 in 1980 and matures for $1,000 in the year 2000. Now I'm able to sell my bond for $1,050. Whoever buys it from me is going to have a current yield of 9.52%. That means he had to pay more than $1,000. At $1,000, the yield is 10%. But on $1,050, he earns 9.52%. But in the year 2000, he's going to have a $50 loss. So his yield to maturity means the buyer will have a 9.52% income stream on $1,050. He then has that $50 loss that is factored in and amortized over the life of the bond, giving a yield to maturity of 9%. Here is a GMAC debenture. What is a debenture? An IOU that is backed by an asset is called a mortgage bond. If that company defaults, you're able to take an asset. If instead it is like a signature loan where no assets are pledged as collateral, it is called a debenture. So the GMAC debenture 7 1/8% of $9,199. That means you will get par or $1,000 on September 1st, 1999 and 7 1/8% on $1,000. AAA plus rated, trading at 99.5. It's 99.5 or $995 per $1,000 bond. At $995, this bond pays 7 1/8 on 1,000, not 7 1/8 on $995, giving you a current yield of 7.16%, and the yield to maturity is 7 1/4%. This bond pays $35.62 every September 1st and March 1st. It might be callable at 100.193. That means that the bond issuer, when they issued the bond, put in a call provision. A call provision means that if interest rates drop, that company is able to call the bond back in, pay it off, and sell other bonds. Always check the call provision. This one is callable at $1,001.93 and callable now. One more example. The General Motors Acceptance Corporation debenture 11 3/4% coupon rate due 7/15/2000. Double A plus rated, selling for $112, which is $1,120 per $1,000 bond. The current yield, which is 11.75%, divided by 1,120 is 10.49%. The yield to maturity, which takes into consideration the $120 loss in the year 2000, is 10.12%. These rates seem out of line with the previous example. What's the catch? The bond is callable in 3 years at 101.50, which is $1,015. So I'll have a $105 loss in 3 years. So my yield to call is 7.75%, which is in line with the other example. Sometimes a bond won't come out selling for par, and a zero coupon bond is a good example of that. Here we have an IOU. Instead of paying 10% or even 5%, it is going to pay you nothing. No current income stream at all. But it is going to mature for $1,000 in the year 2000. So back in 1990, I had 10 years to maturity, and the going interest rate was 10%. Using a present value calculation, I came down to paying $385.54. That means I paid $385.54 then, and I'm guaranteed that at a compound rate of 10%, I'm going to get $1,000 in the year 2000. If it's AAA rated or insured or even a decent rating, I have a reasonable expectation that I'm going to have my money when I need it. We often use this for either IRAs or for children's education funding, where you put the money in and you want to be guaranteed it will be there when you need it. It's called a zero coupon bond. The coupon being the rate stated on the bond. It is zero. Also called OID, or original issue discount, because it was selling at a discount when it was originally issued. One of the catches of zero coupon bonds is that if it is issued by a corporation or by the federal government, you have to pay taxes on that amount that has grown as if it had paid interest. That's called the accreted value. So you've received no income stream, but you have to pay taxes on it. That's okay for an IRA or for a pension plan, since they are not taxable anyway. There's basically 3 issuers of bonds: the federal government, corporations, and states or municipalities. They borrow money by issuing bonds. Now the government and the states have an agreement worked out called a reciprocal agreement. We don't tax your bonds, you don't tax ours. Therefore a government bond is free of state tax, and a state bond is free of government tax. If, however, you own a state bond of which you are a resident, it will be free of state and federal tax. You'll notice government bonds at 7.5%, corporate bonds might be 9%, state bonds are 6.5%. Now why would the state bond be so much less? They are free of federal tax and supply and demand. There is a large demand for state bonds, and so they always find their equilibrium no matter what the tax system is. In the government bonds, you have bonds, notes, and bills, which are just a direct issuance of the government. And you have Ginnie Mae, or Government National Mortgage Association, which is a pool of mortgages. My house, your house, etc., pooled together, insured by an agency of the government, and then sold to investors. So the investors get monthly checks that they have principal and interest. One of the risks in Ginnie Mae's is if interest rates come down drastically, a normal bond would just go up in value. But a Ginnie Mae has no call provision. It is only called as quickly as the people in that pool refinance their homes. So if there's a lot of refinancing taking place, you could have a good Ginnie Mae at a real high rate, and the next thing you know, you're getting all your principal back. But normally a Ginnie Mae will pay a higher interest rate than a bond, which is a direct obligation of the federal government as a whole, because it is an agency of the government. In the state bonds or municipals, there's basically 2 different kinds, and they are broken down into several different categories. You have your GO bonds, or general obligation. That means that the bonds are backed by the full taxing authority of the municipality. That bond is a general obligation of the municipality. They can raise taxes to whatever they need to pay for that bond. Or you have a revenue bond. If the state wants to put in a sewage system, then the revenues to pay off that bond might be only connected to that sewage system or whatever that municipality needs. Maybe it's a hospital bond. If the hospital goes under, the bond goes under. But if it is a GO bond, if the hospital or the sewage system goes under, they can raise taxes and continue the bond. Which one's normally going to take on more risk? The revenue bond. And therefore, the revenue bonds are normally going to pay more. Again, the rating system fits all three different categories of bonds.